Hi James, how you going? Welcome to the property.biz.
Thank you, Anne. It's a pleasure to be here.
Yeah, nice to see you again. It's been a little while. A few things have been happening in the market that's keeping our workplaces very interesting. Number one being interest rates. Yeah, it's been a bit of a tricky market to negotiate, isn't it? You know, with them moving up so quickly.
Absolutely. I mean, obviously, just yesterday we had another 0.5% increase. So cash rates now at 2.35%, coming from 0.1%. So that's a significant jump over a fairly short period of time. So that's had a massive impact on buyer sentiment and, potentially borrowing capacity for a lot of clients. So it's certainly affecting the psychology of the market out there. There's no doubt about that.
100%. I think what I'm finding with people that some people being really caught unawares by the Reserve Bank moving rates, like bringing the rate rises so forward, like i.e. by at least 18 months. I think a few people I know, they really thought that they had that another 18 months of significant low interest rates to keep building on their property portfolio, or i.e. buying that dream property while the interest rates are a lot lower. So with all of that, it's really changed borrowing capacity, hasn't it?
Absolutely. I mean, the way that lenders look at assessing your ability to borrow is simply by looking at the delivery rate plus what's called a benchmark rate. And then the benchmark rate is generally the delivery rate plus 3% with most lenders. It varies slightly, but, as a general rule, 3% is a fairly consistent number. So what we've had now is when we're assessing someone's ability to borrow, we were looking at, say, a delivery rate of 2.5, adding 3% to that. We're assessing their ability to handle a rate at 5%, 5.5%, I should say. And that was generally, then that would determine what their borrowing limit would be. Now, that's altered significantly over the last 4 or 5 months. Now, we're looking at delivery rates around, 4 with a 4 in front of them. Generally, after yesterday, it's probably, 4.5 in many instances. So then when we're calculating their ability to borrow, we're looking at a benchmark rate of 7.5%, which is a significant change. And, it can affect your borrowing limit by a couple of $100,000 in some cases. So as an example, someone borrowing $1.5 million might now be down to $1.2 million. So their circumstances haven't changed, the inputs haven't changed, but the RBA rate increases and the new interest rates that are in the market means the outputs are significantly lower than what they were.
Has anything changed with the process of borrowing? I know there were changes made several years ago around assessing people's capacity. Has there been any adjustments with finance?
Not of any significance, really. There was a big kerfuffle about drilling into sort of micro detail of people's spending habits and looking at 3 months of bank statements to look at where money was going. And there was a bit of blowback on that simply because it was unable to recognise what you would call as essential spending versus, fund spending, I suppose, for want of a better term. And there was a big court case, discretionary spending, of course. So what you're looking at there was a court case, Westpac versus ASIC, and the court case resulted in Westpac being slapped down and being told that it's not a nanny state. People can make a decision themselves about whether they have steak for dinner. Wagyu steak, I think was the term they used, versus minute steak. And obviously if your budget's under pressure, well, you're certainly not going to be buying Wagyu. You're going to be buying minute steak. And your background in the small goods.
That's right, exactly. Definitely.
Spending habits change.
No, and I have been at the coalface of that in my previous career. I was in retail, food retail, and that is the first thing to go. People will always automatically change their budget from high premium steak when times are good to mince and sausages when they're trying to save $1 or $2 here or there, you know, which
That's exactly right.
yeah, exactly. And you know, the other thing too, you know, we hold home ownership in such a high esteem. It's something I talk about all the time, that people will protect that asset over anything. It would be the absolute ultimate.
It's always the first bill to get paid. There's no question.
Yeah,
people will trim everywhere else, but they will make sure their home loan gets paid every month because they don't want to be, you know, selling if they don't need to. You know?
Yeah, exactly. And the banks don't want to go down that road either, do they? You know, I mean, that's the worst thing that can happen.
And we see that all the time. You know, you're not getting the latest iPhone this year, mate. You're going to suck it up and have another year with the old Samsung, for example.
That's right.
So, you know, that's a conversation happening in every household. And, you know, if you've got to pay your bills, you've got to pay your bills. So we're not seeing any issue with regard to sort of redundancy payments of bills and missing loan payments. Not a lot of hardship at all. People are just managing their budgets a little bit more wisely, I suppose, for want of a better term.
Do you think that plays into the Reserve Bank's aggressive uplift in the rates, that they are pretty certain there's enough room in the market to?
There's been a bit of commentary about that, and the thing that that people forget, and I think the RBA are a bit amiss here, is that it's a lagging indicator. You know, if you're looking at spending habits a couple of months ago, it's not reflective of what's happening today. You know, so a rate increase from yesterday, yes, well, based on 2 months ago and consumer data there, you can probably say, yeah, we need to bump it up. But if that in 2 months' time, they might see that they've overcooked it, for example, and said, well, you know what, it's now, you know, hit and probably hit harder than we need to do. We'd better put the handbrake on for a bit now. So it's a blunt instrument. That's the issue. It's
100%.
really not, in my personal view, not being wielded that wisely at the moment, simply because we're seeing the impact it's having on the property market. We're seeing the impact it's having on, you know, on day-to-day spending, and that doesn't flow through to the RBA until a couple of months after. So
yeah, that's right. Yeah, I saw a market like that. I think it was in the early 2000s. They moved rates like really, really quickly. Like they were around about 5%, and then they went right up to 9%.
That was just pre-GFC.
Pre-GFC, wasn't it? Yeah.
And then it all went wrong.
Yeah, but then they had to bring them down as equally as quick because there was too much hurt in the market.
That's exactly right.
Yeah.
So it remains to be seen. We'll have to sort of all unfold and we'll know what happens.
Yeah. Well, we've already seen around about a 12% drop in the market as far as house prices. I'm hoping that sort of sustains itself for a while.
Look, I'm seeing that, you know, my dealings with agents, that the market seems to have found a bit of equilibrium at the moment. I think, you know, buyers are quite happy that, you know, the market has dropped. You know, that's a fairly significant impact, but compared to where we were, you know, 3.5 years ago, 2019, you know, we've gone up 30 to drop 10-ish.
Yeah, exactly.
You know, plenty of people are still winning. Now, what I'm seeing at the moment is that it's brought a different profile, a different demographic into the market, where we've got investors now who are seeing rates, or I should say rents are going up. Suddenly, you know, interest is tax deductible to the investor. Prices are down 10, 15% in apartments in some areas. So suddenly those types of properties are looking more attractive. I've also seen a fair bit of activity in upsizes where, you know, if you're moving from a $1 million property into a $2 million property, for example, a 10% reduction in both, well, it's 100 grand on your million, it's 200 grand on your $2 million property. There's $100,000 of winning there if you're upgrading. You know, even if rates are going up, you're still getting into better property at a better price than, you know, what would have been previously.
Yeah, so it's not all bad news, really, is it? You know.
Look, I'm saying there's not, for some reason, there's not a lot of people buying at auction, but there's a hell of a lot of property still being sold post auction. You know, so this is not the sort of stuff you see in the media. You know, if it doesn't bleed, it doesn't lead, I suppose, is the old newspaper maxim. So, you know, that sort of stuff isn't really filtering through in the general public.
Yeah, no, I totally agree with all that sentiment. Yeah, definitely. That's definitely what we're seeing. That investors have been there. I've seen a lot of investors have been sitting on cash for a couple of years, and they've just been waiting for this moment pretty much to step back in again, and hopefully it'll improve the rental market at some point down the line.
We're also seeing a fair bit of first home buyer activity with the government incentives, you know, opportunities to save 10, 20 grand in lenders' mortgage insurance. Suddenly, you know, that becomes a more attractive proposition. If you've got a young couple who have got a bit of money in the bank and they're not paying mortgage insurance, the banks are happy to lend you money. As I said, if a classic example, a couple of young professionals are just looking to purchase a property for $100 million. First home buyers, they're not paying any stamp, well, they're not paying much stamp duty. They're not paying any mortgage insurance. They've got strong incomes. You know, deposit saving is always a sort of issue for that type of buyer. But suddenly now they're into you know, a property with $50,000, $60,000 deposit, no stamp duty, no mortgage insurance. It's a pretty good transaction for them.
Yeah, definitely. Yeah, definitely. Lovely. Well, thanks for your time today, James. I really appreciate it.
No, it's always a pleasure. Happy to help.
Thanks for that. Bye.
Thanks, Anne.